So how do you make money trading on the stock market? For me, there's three things. The first one is marginal gains. Tiny little improvements that you make to your trading plan that add up to a lot of money in the long term. Secondly, it's the opportunity cost of capital. What else could you do with that money? If you've got loads of money already, it doesn't matter what else you could do with it. But if you haven't got loads of money, then it's very, very important to track every single dollar. And thirdly, it's about honesty. You've got to be absolutely honest about your trading performance so you can apply the marginal gains to it. I've just published an article about QuantumScape on Seeking Alpha, and I'm going to use that as a kind of template, an example to show you some of the important things that I've learned over the last few years, some patterns that I've spotted that repeat, and some ways to improve my trading performance. On the screen in front of us is my article I've just written and just had published on Seeking Alpha. I publish all of my work on Seeking Alpha, and it deals with one of the issues I spoke about, honesty, because I can't get away from what I've said. If I click on my name there, we can see on the website for everyone to see is every article I've written on what I've said about every company. It's too easy otherwise to just ignore the ones that went wrong and pretend they weren't part of your normal plan, and you won't make that mistake again. I can't do that, and it's important that you don't do that. You need to look at everything you've said. If we look at this article here, Burner, published quite recently, we can see how it's exact. It tells me exactly the day I said I'd buy it, exactly what's happened since then, both the change in Burner and, very importantly, for opportunity cost of capital, the change in the S&P. It's not always been doing quite as well of that. And if we look back, we can see one here that I wrote over 12 months ago, March 2023, and we can see that just hasn't done as well. I said here to buy it, and since then it's down 92.93%. That isn't great. But what you do is you look for patterns, you look for things that keep recurring when you do badly and keep recurring when you do well. And I noticed on the, a repeated pattern where prices shooting up and then coming down and just settling and going flat along the bottom for a long time. This has happened with a number of things I've written about, and I researched into this and I found Gartner. Now, Gartner have a product they call the hype cycle, which lets you look at new technologies. They talk about how a new technology arrives and prices shoot higher on nothing more than hype. And when people don't, when that hype isn't realised, when people don't make money out of it, it comes back down again to zero. And the truth is, the technology is still good, it's just not useful for business at the moment, so it can't generate any money. And you don't want to buy it until it starts to become useful, until we get to this area. They call this enlightenment, where business starts to realise it can actually make money out of this technology. And that was the problem with the graph I just showed you. I bought it way too early. And I've introduced the hype cycle into my trading pattern, a marginal gain that stops me buying into the hype, and it makes me concentrate on when this technology will actually be useful. So let's have a look. Let's suppose I didn't know about this and I bought QuantumScape when it was still in the hype. If I go back here, we can see, let's suppose I bought it on January the 1st, 2021. At that time, QuantumScape was valued at $49.96 and the S&P was valued at 3,700. On January the 1st, I had an option. I had an opportunity. I could have invested $1,000 in QuantumScape, or I could have invested $1,000 on S&P. The S&P investment was much easier. I just give that to some manager, or I buy an ETF and passively do nothing about it. Today, my potential QS investment would have worth $116, and my potential S&P investment would have been worth $1,515. So the opportunity cost was minus $1,399. Now, I'm not rich enough to be prepared to chuck away $1,399 just on the hope of it getting better. A lot of people will disagree with me. If we look at the chart of the QNS, we can see the hype cycle in action, from zero, going higher, coming down, because it's not useful to business yet. They can't make any money out of it. A lot of people will say that when it gets down here, what I should do is buy some more and reduce my cost of capital. The price was up here. If I bought it then, if I bought it in 2023, then my actual cost would have somewhere halfway between the two, and I could have keep getting that cost down a little bit, just buying more and more and more shares till it got to here. And people tell you, if you believe in this product, you should just keep buying into it. I don't do it because of opportunity cost of capital. It will just cost me a lot of money, and there's other things I could have done with that money, and I could have done quite well out of it. I don't want to lose masses of money. If we look at how that responds in my portfolio, we're here. In 2023, I invested $2,431 in my investment. I could have invested it in the S&P. In 2023, I recorded a 34% return on my strong buy portfolio. The S&P only 14%. If that performance kept replicating for the next 5 years, in 5 years' time, my portfolio would be worth $31,800, and the corresponding S&P portfolio would be worth $18,000. So it's assuming every year I invest $2,431 and I get these 2% returns. So the opportunity cost of capital was positive $13,400. That's what I want to have. If it carries on for 10 years, by the 10th year, my portfolio will be worth $169,000 versus $53,000 of the S&P. That's how I'm going to make wealth out of this thing. That's how I'm going to grow my capital. That's what's hopefully going to happen. Now we've got the strong buy portfolio in front of us, and we can see there are three. This was actually yesterday, and we can see there are 3 trades causing me concern. Net Power is down 16%. Elva, Electrovia, down 26%, and Intuitive Machine down 23%. Obviously we're going to look at those 3 and make a decision. Should we keep them? Should we not? Got my strong buy update for Q2 2024. We can see that's the earnings that everybody released. So Electrovia, one of the 2 I'm looking at, missed both its earnings and its revenue. Net Power missed on earnings. Luna missed on revenue but hit its earnings. Those are the 3 we're looking at, and you'd kind of expect that, wouldn't you, that the drop in price reflects something real. If we look at Net Power first, they plan to open their first site in 2028. Between 25 to 26 they're going to be testing. Now that's already sounding like a hype cycle issue, isn't it? It's not. This technology is not yet useful. You can't actually make any money out of it. We've got some other negatives. Greenlight, one of the big hedge funds, exited their position completely, and the price targets given by analysts have collapsed from $35 to $11. When I look at my model, which is how I decide if I'm a hype cycle or not, because if my mathematical model, if my prediction can give me a break-even date and a fair value for the shares, then I know we're out of the hype cycle. I know we've got a useful product. I don't have it. There's a very good chance that we've got 3 years of falling prices ahead. So Net Power, I'm going to close that because I got in too early. When I bought this trade, I didn't have the Gartner life cycle in action. It wasn't part of my trading plan, but now it is, so that one's got to go, and maybe I'll get back into it in 2027, 2028, who knows. Next trade, Electrovia. Now I did have the Gartner hype cycle in my plan when I bought Electrovia, and at the time it all looked positive. We had a break-even forecast which was meant to be this year, and we have a fair value price more than 100% above where we are now. However, things haven't gone quite so well. Orders have shifted from 24 to 25, so they're not going to break even this year. They've reduced their guidance for future years, which means that no longer do I have them being worth 100% higher than they currently are. They're starting to fail a little bit in my mind on technology. They were developing solid state batteries like QuantumScape, and a year ago they seemed to be more or less on par with QuantumScape, but that's not the case anymore. They seem to have changed what technology they're researching and have kind of almost gone back to a new line of research. There is some positives. They've signed with an initial OEM for their forklift truck batteries. They signed up with a big trading house, which is really good, but they're not progressing as we hope. The New York site seems to be on a little bit of a hold. It's just not going as it should. So we're going to get out of Electrovia for the time being and just take the hit. avoiding what looks now like 2 years of falling prices. Opportunity cost again, don't want to be in for 2 years of falling prices. The last one we want to look at, Intuitive Machines, is different to the other two. Price is down considerably, as we said, but they've raised their 2024 guidance, which is now double from 2023. They've increased their cash flow, and the orders for the next 6 months look better. They've sold out Mission 2, and Mission 3 sales are going really well. These are missions to the moon, by the way, so they're quite impressive things to do. They're expecting some key contract awards later this year, and they've expressed an interest in buying the cancelled Viper product from NASA. So on Intuitive Machines, everything looks good. Still got in target the break-even date, still got them more than 100% above where we are. Don't think we're in the hype cycle, because this product is already useful to industry. People are buying space on their rockets, so we're not getting out of Lunar at the moment. So this is what the portfolio now looks like. We can see that Net Power and Elva have both been closed, everything else remaining open, and it's looking reasonably good. If we have a look at the analysis, closed trades, we've now got 4 trades closed, only one of them winning because we closed 2 losing trades today, for a total return of 35%. The open trades, we've now got 8 winning for 73% and 25% return. If we look at the what's now, we're in the second year. So the first year, our return was 34% against the S&P of 14%, which is really good. Outperformance 243%. But this year, so far, we've got 7% as opposed to the S&P at 3%. So it's looking really quite promising. I'm very, very pleased, and I'm just continue doing this, and hope you can join along, and hope you can make a little bit of money out of it also. Well, that's it for today, everybody. I hope you enjoyed it. Got a little bit of extra money in the account now, because we've just closed a couple of trades, and I've got some great trades coming up, I think. I'm currently looking at 2 strong buys that I'm going to publish on Seeking Alpha, and I've got 2 microcaps that I'm really interested in. I think September we could well be starting that microcap strong buy portfolio. If you enjoyed the video, hit the button. If you want to hear about those extra trades that I've got coming up, please subscribe, and I look forward to speaking to you all in the future. Thanks very much for your time. I really appreciate it.